because most of the earnings will be out.
Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Chris Dearborn. He's the managing director on Nasdaq's market intelligence desk. Chris, great to have you back with us. Welcome back from vacation. I'm sure you had how could you not have a good time in Kauai, right?
You had a great time in Hawaii. Kauai is heaven on earth, and half
and
the
you
day
came back
is
to some
heaven.
Interesting market action. That
I
is
did.
for sure. I mean, the Nasdaq Composite in the green right now. It was telling a very different story this morning.
It is put upon a tidal wave of activity.
Yes.
So the markets had a huge reversal day today, right? We're not done yet. Today may be the heaviest traded day of the year. So you've only had 2 days so far this year. We've had the average daily volume over 10 billion shares. So it was both expiration days back in March and then back in June. Last Thursday, we almost got the 10 billion, the 9.9 billion on the consolidated tape that's between the NYSE and the Nasdaq volumes. And that was the major reversal day. It started out as a positive day following the reversal from Powell's comments from Wednesday. And then when the president's tweet, the markets kind of rolled over again.
Right, and that lends to the question,
Yep.
Is this a risk-off environment or a buying opportunity? Do you think that could be the reason why there's a volume
It's a disjointed
surge?
environment is what it is.
Right.
You've had 6 days of losses coming into yesterday's nice rally, especially towards the end of the day. Today, the markets coming in on the futures at like 7:30, 8 o'clock this morning when we walked in the door was positive. The Dow was looking up like 40, 50 points, and all of a sudden the market started to sell off. And the pundits on TV were looking for a reason why. You had a number of different items out there that kind of could have pointed to a negative environment, risk off, global slowing, but it's a theme, right? You have New Zealand cutting rates more than expected, India cutting rates more than expected, Thailand coming out, cutting their benchmark unexpectedly. And with that, it's just a reiteration of a global slowing environment. So why would that reverse it? Well, you're looking at a lot of profit taking, right? We recently made highs in the market across the board not too long ago. It's still somewhat of a summer environment. If you had items like that and the move today taking place in Q3 or Q4 or even Q1, the markets would be, let's say, even more volatile. So right now you're looking at, we were down over 1.5% at one point this morning. Now you got the Nasdaq in positive territory, fluttering with even going higher. The Dow, if it wasn't for Disney with earnings, would probably be even higher. And with that, you're seeing a broad-based market rally. Buying opportunity potentially, but what you're not seeing is that capitulation move. We're hoping, thinking maybe this morning might have been because there was no real reason for it. People were just selling off. If the volume tops 10 billion shares today, it could be a good starting point for the markets moving forward for the rest of the summer.
All right, let's take a longer term look at the S&P 500. We'll pull up a 5-year here so we can kind of gauge what you're looking at longer term.
Right, so what you're looking at here is a 5-year weekly, and we put this in the note today, and the reason I put it in today is because it shows a broader picture. The 1 year paints a very different chart than the 5-year. The 1 year is saying there's no support. We're going to break down to 2,800, which is the 200-day moving average on the yearly. If you look here on the weekly, though, we still got major support. The 50-week is sitting right there, and you haven't even touched it on a weekly closing basis. What you're looking at here is not necessarily a capitulation movement, but a correction, and it's still positive looking forward. If you look from the left to the right on the chart, especially towards the far end behind you, Jill, you're looking at the markets kind of selling off, but not giving up everything on a weekly basis. And with that, you're seeing support in the stocks, support in the broader base names, and of course, tech is leading the way here today. And with that, tech has been the leader for the last couple of years and will continue to be that leader, followed by probably consumer discretionary, and you'll have other sectors making it up. The financials are taking it on the chin a little bit, and the reason is that because you have a lower rate environment with the expectations of banks not being able to have as much profit based on the loans and the credit cards and everything else that they're giving out because interest rates are going lower. Who's going to be the beneficiary of that? Companies that have a lot of debt. The only sector that's not really participating in that is the energy sector, right? Oil is coming into another low. You had a big draw. You had a bill as opposed to a draw coming in. The geopolitical factors out of the Middle East aren't impacting oil as it usually does. Again, the market is disjointed a little bit here. So you're looking for that new leadership, and you're going back to what the leadership has been since the presidential election, even beforehand, and that's tech. And that's what's going to pull us higher.
Well, you have to be grateful you're not in triple levered oil ETFs. That is for sure. On Friday, let's take a look at that NDX so we can see that leadership in tech stocks. Our last chart of the day, the U.S. 10-year bond yield, and of course, bond yields, that's a big part of the narrative as well.
Absolutely. So this is what's caused the sell-off this morning. All right, the 10-year bond made a new 2-year low today. It is trading about 1.65 on the yield, which is showing that people are running to safe havens. There's gold, which topped You know, 52-week high today at over $1,500 an ounce on the front contract, and the second month contract was even higher. And what you're looking at here is people are buying bonds because they're unsure of where the markets go. Investors don't like uncertainty, and when you see bond yields plummet, is telling you that there is uncertainty in the market. People are still plowing in the stocks because as a short-term trading environment, there's got to be a bottom here and there, and people will continue trading short covering, et cetera, that goes along with it. But the true tell here is the bonds. Look at the gold. I should have had that chart up here as well.
Right.
Gold's trading at 52-week highs there. So you have people who are selling stocks and putting them into the safe havens, the treasuries, government debt, definitely. You know, in the note today, I talked about the 30-year yield on the German Bund. It's at negative rates. So why would you want to pay somebody to hold your money to get back less money? Because you're uncertain of the other environment.
Right, so that you don't want that shock. It's a big shock in the system if you get a 20% move down in stocks, but you're willing to hold your money with negative interest rates, kind of sustain that a bit.
Absolutely. And that's what you're looking at here with the 10-year of the U.S., which is one of the most commonly held bonds out there. Again, it's not a free-for-all, but uncertainty breeds safety for people who want to invest and you want to protect your money as opposed to grow it at certain points. And you don't mind missing a couple of points here and there, especially near the highs. Right. So I'm willing to watch this chart. I don't think it goes that much lower unless something more macro happens. Again, the trade talks are really where is everything. And if you get positive feedback coming into September, if he goes from 10% to 15 to 20% on the 200 billion, things will get a little uglier, right? But if that doesn't happen and the trade talks start to become positive in the U.S. and China, this market will rally on the back of that, and everything that's been sold off will start to rally on the equity side, and you'll see people start to roll back out of the 10-year, out of the government debt, and put their money into the equity market.
Yeah, it certainly has some room to go relative
Absolutely.
to its moving averages. All right, my friend, I'll catch up with you on Friday to wrap up the
Jill.
week. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.